If you want to succeed in the years ahead, especially in a world that's undergoing rapid change, the first and most fundamental principle is this: understand reality and deal with it as it is, not as you wish it to be. Most people make the mistake of looking at investments through the lens of recent experience or personal bias. That's a dangerous way to approach markets, particularly at this stage in the long-term debt and political cycles. We are in the midst of a historic inflection point economically, geopolitically, and technologically. Interest rates are no longer at zero. Inflation isn't dead. Geopolitical tensions are escalating. Productivity growth is no longer guaranteed. And the global order that many investors have grown up with, the American-led unipolar world, is being challenged. In times like these, old formulas break down. The environment demands that investors become students of history and students of systems. Let's start with the big picture. We are late in the long-term debt cycle. Debt levels across developed economies are near or above historical extremes. Monetary policy, once effective in stimulating growth through rate cuts and liquidity, has become less potent. In this phase, governments rely more on fiscal stimulus, spending financed by printing money, but that leads to currency debasement and capital flight. So you can't just sit in cash. It loses value silently. You also can't blindly hold long-duration bonds. They may not protect you like they did in past downturns. That leads to the principle of diversification, not just across assets, but across environments. It's not enough to own 60% equities and 40% bonds anymore. That mix assumes a certain economic regime that may no longer exist. What you need is balance between assets that perform well in inflationary periods, like commodities or inflation-like bonds, and assets that do well in disinflationary or recessionary conditions, like quality equities and some fixed income. You need protection against currency debasement, gold, strategically placed real assets, or even exposures to other monetary systems. The other thing investors often miss is the power of correlations. Correlations drive risk far more than most realize. When assets go down together, it's a signal your portfolio wasn't really diversified. That's why the real goal isn't just return. It's risk-adjusted return. It's resilience. It's the ability to survive and compound through all seasons. And make no mistake, risk is rising, political polarization is up, trust in institutions is down, and social contracts are under stress. That makes future tax regimes, regulatory policies, and property rights more unpredictable. So you have to think not just about where assets are, but under what jurisdiction, what legal system, what political environment. A well-diversified portfolio must span geographies and systems to reduce vulnerability. Most investors focus too much on trying to be right. The real edge comes from being prepared to be wrong. That means stress testing your assumptions, building in buffers, creating asymmetric payoffs. The best investors are humble learners, always probing, always adapting, always seeking truth over ego. Looking forward, the advice is clear. Don't bet on any one outcome. Bet on preparedness. Structure your portfolio so you don't have to predict the future. You can thrive across futures. Anchor yourself in principles that have stood the test of time. Understanding cycles, managing risk, staying balanced, and use them to navigate the unique terrain ahead. The future will belong to those who remain clear-eyed, flexible, and grounded in reality. Not those chasing what worked yesterday, but those adapting for what lies ahead. You know, the most important things I've learned over decades of studying economies, markets, and human behavior is that the most dangerous thing an investor can do is to become detached from reality. The world doesn't care about your opinions, your preferences, or what you want to be true. It moves according to objective forces, most of which have played out in cycles for hundreds, sometimes thousands of years. The best decision making comes from being able to see these forces clearly and operate in harmony with them. Most people don't do this. They operate emotionally. They get caught up in what just happened or what they hope will happen. But markets don't reward hope. They reward understanding. And that understanding starts with the willingness to confront the brutal truths of the current environment, however uncomfortable they may be. Investors who avoid this tend to make the same mistakes over and over, buying high, selling low, chasing narratives, ignoring risks, because they're driven more by impulse than by principles rooted in reality. When you strip away the noise, the essence of good investing is simple. Understand how the machine works, understand where we are in the cycle, and understand what is priced in. You can't do any of this well if you're operating from assumptions that are false or outdated. In 2025, this is more important than ever. We are living in a time of fundamental change, economically, politically, and socially. The environment we're in now is not the same as the one we had over the last decade. The conditions that led to strong equity returns, low inflation, and zero interest rates are no longer present. Yet many investors still act as if they are. That's a problem. You have to stay anchored in reality, and that means constantly stress testing your views, looking at data objectively, and challenging your own beliefs. You need to ask, what's really going on here? What are the forces at play? What am I missing? If you're not doing that, you're likely setting yourself up for surprises. And in markets, surprises usually mean losses. This isn't just about intellectual honesty, it's about survival. The markets are unforgiving to those who live in illusion. The more honest you are with yourself, the more likely you are to adapt early, act effectively, and avoid the pitfalls that trap so many others. It's not about being smart, it's about being real. So if you want to succeed in investing, not just now, but over the long term, you have to make a habit of grounding every decision in truth. Look past the headlines. So ignore the crowd. Focus on the fundamentals, the historical patterns, and the timeless principles that govern how money, debt, productivity, and human nature interact. Reality is the ultimate teacher. If you can learn to embrace it rather than resist it, you give yourself a significant edge, one that most investors never develop. Understanding where we are in the long-term debt cycle is one of the most important things an investor can do right now. The reason is simple. Different stages of the debt cycle create fundamentally different environments. And if you're not aligned with the phase we're in, you're likely to make decisions that will hurt you badly. Most people think in short-term increments, quarter to quarter, maybe year to year, but economies move in long arcs driven by credit, productivity, demographics, and human nature. Debt cycles typically last 50 to 75 years, and we are now late in that cycle. That has massive implications. In the early stages of the cycle, debt growth fuels productivity, investment, and expansion. But eventually, debt levels rise faster than income. When that happens, interest burdens grow, credit becomes harder to sustain, and central banks are forced to intervene more aggressively. That's exactly where we are now. Global debt is near record highs. Central banks tried to fight inflation by hiking rates, but now they're caught between a rock and a hard place. Tighten too much and you break the economy, ease too much and you reignite inflation. What's important to understand is that we've entered a phase where traditional monetary policy, moving interest rates up and down, isn't enough. So fiscal policy steps in. Governments borrow and spend trying to keep growth alive. But when they do that, while the central bank is also printing money, what you get is monetization of debt. That's not just an academic concept. It has real consequences. It debases the currency. It pushes people out of cash and bonds. It creates volatility. And if it goes far enough, it can lead to a loss of confidence in the system itself. So you can't look at 2025 and expect a repeat of the past decade. The rules are changing. You can no longer rely on bonds to offset equity risk the way you once could. In fact, long duration bonds might be one of the riskiest places to be if inflation stays sticky or reaccelerates. And cash, while it feels safe, it's quietly losing value when real returns are negative. The playbook has to evolve. Investors need to understand the mechanics of how money is created, how debt is serviced, and how governments are likely to respond when the pressure builds. This understanding isn't just theoretical, it's practical. It tells you why inflation hedges matter, why geographic and asset class diversification is no longer optional, why resilience matters more than return chasing. If you fail to see where we are in the debt cycle, you'll be blindsided. But if you do see it, and if you position accordingly, you'll be ahead of the curve while others are still reacting. That's how you gain the edge, by aligning your strategy with the deeper structural forces shaping the economy, not just the headlines. The single biggest mistake I see investors make is thinking that diversification means owning a lot of different things. They buy stocks, maybe a few bonds, sprinkle in some international equities, and believe they're diversified. But when you dig deeper, you realize most of these assets are highly correlated, especially during times of stress. That's not diversification. That's disguised concentration. And in today's world, with more volatility and regime shifts ahead, that kind of setup is dangerous. True diversification doesn't just come from owning different assets. It comes from owning assets that perform well in different economic environments. The global economy moves in cycles, and those cycles are driven by two primary forces: growth and inflation. And if I asked you to give me drastic rationality in terms of what did well in which one, and then different global economies move in different economic environments. And when you map that out, you get four basic environments: rising growth with rising inflation, rising growth with falling inflation, falling growth with rising inflation, and falling growth with falling inflation. Every asset class responds differently to each of these environments. In an ideal world, you want a portfolio that has balance across all four. That means holding some assets that do well in boom times, like equities, others that do well in inflationary environments, like commodities, inflation hedges, or even certain types of real estate. Some that perform when growth is weak, like high-quality government bonds, and some that protect against tail risks, like gold or safe haven currencies. What you're doing here is engineering balance, not betting on any one environment, but being prepared for all of them. That's what reduces volatility, protects your downside, and allows you to compound wealth over time without getting wiped out in any single cycle. Most investors don't do this because they're too focused on recent performance. They chase what just worked. That's a mistake. The market constantly shifts, and what worked yesterday often won't work tomorrow. Think of it like a well-built machine. Each part serves a different purpose, but together they work in harmony. When one part underperforms, another picks up the slack. That's the magic of true diversification. It doesn't just lower risk, it often improves returns by keeping you invested and steady through uncertainty. In a world like 2025, where inflation may return, where central banks are experimenting, where geopolitical tensions can spark sudden moves, you need to own a portfolio that doesn't rely on one outcome. Because the reality is, we don't know exactly what's coming. No one does. But what we can do is structure our exposure so that no matter what path the world takes, we're not wiped out. We're resilient. This mindset, diversifying by environment rather than by asset class, is foundational. It's how you shift from speculation to strategy. It's how you stay in the game long enough to win, and in a world of greater uncertainty. That's not just a good idea, it's essential. When people look at their portfolios, they tend to focus on returns, but what they often miss, and what matters more in the long run, is how the pieces of the portfolio interact with one another. It's not about how much you make when things go right, it's about how much you lose when things go wrong. That's where correlations come into play. Understanding correlations is one of the most underappreciated yet most powerful concepts in investing. Most assets are correlated more than investors realize, especially in times of stress. When the tide goes out, when there's a shock in the system, you often find out that what you thought were independent positions were actually moving together. That's how people who thought they were diversified end up experiencing massive drawdowns. They confused having many positions with having uncorrelated bets. But correlation is what determines your actual risk exposure, not the number of holdings you have. If two assets go up and down together, owning both doesn't really reduce your risk. On the other hand, if one zigs while the other zags, they offset each other and your overall portfolio becomes more stable. That's what you're aiming for, not just returns, but consistency, a smoother ride, lower drawdowns, better compounding. In today's environment, this becomes even more important. With rising uncertainty, you need to assume that unexpected events will happen and that when they do, most conventional assets might behave in similar ways. That's why just owning stocks and bonds or putting your money across sectors isn't enough. You have to be intentional about choosing assets that are genuinely uncorrelated. This requires deep understanding, not just of the individual assets, but of the drivers behind them. What moves them? What environments cause them to rise or fall? It also means building portfolios that are more than just diversified. They're engineered. You want to build in balance. You want to build in resilience. And to do that, you have to go beyond surface level diversification and dive into the math of risk. That includes calculating correlation, stress testing your portfolio under different scenarios, and constantly reevaluating as the world changes. This is especially critical when you realize that correlations are not static. They change depending on the environment. Assets that appeared uncorrelated during normal periods can become highly correlated during crises. So you have to monitor this constantly and adjust accordingly. At the end of the day, the best investors are not those who chase the highest returns. They're the ones who construct the most balanced portfolios. They know that the path to wealth is not just about upside, but about surviving the downside. And that requires more than owning a basket of assets. It requires understanding how those assets behave together and building a system that works under many different conditions. That's how you protect yourself. That's how you grow. That's how you win. One of the more overlooked aspects of investing, especially in today's environment, is the role of geography and governance in protecting or threatening your capital. Most investors focus on what they own, stocks, bonds, real estate, or businesses. But just as important as what you own is where you own it. The idea that capital is always safe simply because it's invested in a developed country or a blue chip market is a dangerous assumption. History shows us repeatedly that political systems, tax regimes, regulatory environments, and social contracts can change quickly, especially in times of economic stress. We're entering a period where geopolitical tensions are rising, economic inequality is fueling populism, and trust in institutions is breaking down. These forces don't just shape the news cycle, they shape the rules of the game. If a government becomes desperate enough due to high debt levels, inflation, or unrest, it will do whatever is necessary to preserve itself. That may mean raising taxes on wealth, increasing capital controls, changing the treatment of certain investments, or even restricting movement of money altogether. If you haven't built these risks into your thinking, you're exposed. That's why geographic diversification is more important than ever, not just in terms of where your assets are located, but also under which legal systems, which governments, and which currencies. A portfolio concentrated in a single jurisdiction is vulnerable to the whims of that jurisdiction. You might think your capital is safe, but if the rules change overnight and you might not be able to access it, move it, or keep it from being taxed at punitive rates. Think about it like this. You're not just investing in companies or markets, you're also investing in systems. And some systems are more stable, transparent, and investor-friendly than others. You need to think about the soundness of the rule of law, the independence of institutions, the likelihood of political upheaval, and the trajectory of public debt. These aren't just academic concerns. They're practical factors that determine how secure your assets are. This is especially relevant in the 2025 landscape. With mounting government debt and political divisions, the temptation to shift burdens onto the private sector is growing. That could mean wealth taxes, transaction taxes, unrealized gains being taxed, or limitations on offshore holdings. If you're not positioned to weather that kind of environment, you're vulnerable, not because your investments are bad, but because the environment has changed. The solution isn't panic, it's preparation. It's thinking globally. It's owning assets in different jurisdictions. It's diversifying currency exposure. It's being aware of where the pressure points are, both economically and politically, and allocating accordingly. In a world where the risks are no longer just economic, but systemic, your ability to protect and grow your wealth will depend not just on market choices, but on structural choices. It's no longer just about what you buy, it's about the framework you're operating in. The most successful investors I've studied or worked with over the years didn't win because they always got it right. They won because they were prepared to be wrong. This principle is one of the hardest to embrace, especially in a world that celebrates conviction and confidence. But conviction without humility is a recipe for disaster in markets. The truth is, no one knows for sure what will happen. The world is far too complex, the variables are too many, the interactions are too dynamic. So rather than try to be right all the time, the key is to build a system that allows you to be wrong and still survive. Better yet, to still thrive. Most people operate from a place of ego. They tie their identity to their ideas. When those ideas are challenged or proven wrong, they double down or deny. That's not strength. That's fragility. Real strength in investing comes from knowing that being wrong is part of the game and designing your approach accordingly. This means stress testing your assumptions constantly. It means asking yourself, What if I'm wrong? Every time you make a move. And it means having safeguards in place for when inevitably you are. This is where the concept of asymmetry becomes essential. You want to position yourself so the upside is significantly larger than the downside, so that when you're right, you gain a lot, and when you're wrong, you lose little. That doesn't happen by accident. It happens by design. It's the product of thoughtful positioning, risk control, and humility. The best portfolios are not built on predictions. They're built on probabilities. You have to constantly consider a range of scenarios, not just the one you think is most likely. The markets don't reward certainty. They reward adaptability. And adaptability starts with a deep understanding that the future is unknowable and that the best way to navigate it is through balance, flexibility, and openness to new information. In 2025 and beyond, this mindset will be more important than ever. We're in a world with rising complexity, political instability, technological disruption, debt overhangs, climate events, and social pressures. Any one of these could be the trigger that shifts the entire landscape. So instead of trying to call the next big move, the smarter strategy is to prepare for a range of outcomes. Build a portfolio that's all weather, one that doesn't depend on a single environment, one that can take hits and keep compounding. Humility isn't a weakness, it's a strength rooted in realism. It's the foundation of resilience. The world will surprise us. Mistakes will be made. The question is whether you're positioned to learn from them and grow, or whether they take you out of the game. In investing, survival is underrated. Those who stay in the game longest, thoughtfully, carefully, strategically, are the ones who ultimately win. In a world marked by uncertainty, debt burdens, geopolitical shifts, and rapidly evolving economic regimes, the path forward for investors is not through prediction, but through preparation. Success will belong to those who stay grounded in reality, diversify intelligently across environments and jurisdictions, manage correlations and risks with precision, and above all, maintain the humility to know they can be wrong. It's not about betting on what you hope will happen. It's about building a resilient strategy that can weather whatever does. In times like these, survival is strength and resilience is the real edge.